a pleasure for me to introduce Benoît Coeuré, who's agreed to do the speech tonight. So Benoît Coeuré has been a member of the executive board of the ECB since January 2012. He has previously held various international and policy positions, notably at the Treasury, at the French Treasury. He also was a co-head of the Paris Club. He has taught and written extensively on issues of the international financial and monetary system, economic policy, and European integration. So, Benoît Coeuré, thanks very much for accepting this invitation tonight.
So I was instructed to switch the mic on. I hope it works. Good evening to all of you, and thank you very much for the invitation. I feel really sorry that the speech is being filmed. So, sorry for you, because there will be no bad jokes and no comments on the speech that was prepared for me by my colleagues. But what's the good news is that the Q&A is not filmed, so you can have you can expect maybe some candid answers. We'll see. Let me share with you a few thoughts on the zero lower bound and what it means for from a central bank's perspective, and what it means from the perspective of a central bank which actually has an effective lower bound, which is below zero. So we have some experience to share here, and let me congratulate and commend the organizers of the conference for having selected this fascinating topic. It's fascinating for market people, it's fascinating for economists, and it's fascinating for policymakers. So that was really a brilliant idea to choose it. So let me try to share a few views on what really the zero lower bound means for us, and whether there are ways to push it further down or maybe eliminate it. And that will certainly echo a lot of the discussion that you had in the conference. And as I was reported some of the comments in the conference, I may be a little bit contrarian here, but that's what you need in a market, I guess. So we'll see. The starting point here is that the existence of an arbitrage relationship between the return on short-term nominal bonds and the return on cash has been long known in the academic literature. There is a remark by John Hicks already that so long as rates of interest are positive, the decision to hold money rather than lend it or use it to pay off all debts is apparently an unprofitable one. So from a portfolio choice perspective, cash under normal circumstances is a strictly dominated asset. It's subject to the same inflation risk as bonds, but it yields zero return. So that's the starting point. And it also has long been known that the relationship would be reversed in the return on bonds were negative. And in this case, an investor would be certain of earning a profit by borrowing at negative rates and investing the proceedings in cash. So if you ignore storage and transportation costs for cash, then there is a zero lower bound on nominal interest rates. That was merely a theoretical notion until recently, until the inflation settled at a lower level. It became first a concrete concern for monetary policy in Japan and then in most other developed economies. And so what was mostly a theoretical curiosity has now reached the universe of policymakers. And also because it is a fact that the storage and the transportation costs for cash are not negligible in reality. The notion of a zero lower bound has been progressively replaced in policymaker thinking by the notion of an effective lower bound. So I would prefer to speak of an ELB rather than a ZLB, since the lower bound is in effect lower than zero, and we've proven that. Let me, in my remarks today, I will argue that while there is an effective lower bound for short-term rates, in fact, it does not really impose a binding constraint on the effectiveness of monetary policy. So, in a sense, the question on how binding is a zero lower bound for me has a simple question that it is not very binding, and so it may not be worth spending too much time finding ways to suppress the zero lower bound, given that it is in fact not very binding. So that will be the main message. I will try to explain that there are available tools to deal with this constraint, of which the non-standard monetary policy measures that we've taken at the ECB and other central banks have taken are part. And I will also challenge the notion that structural changes in payment habits, and that in particular removing cash, moving away from cash, would be the solution to address the lower bound constraint. So in that sense, I will be relatively contrarian if I understand well what has been discussed in the conference. So let me start with a simple question: where is the effective lower bound? That's a very practical question for us as a central bank. That's an operational question for us in our monetary policy framework. As you know, the ECB operates on the basis of a corridor system. We have the interest rate at which we normally provide most of the liquidity to financial institutions, which is the MRO rate, the main refinancing operations rate. We have the marginal lending rate, which incorporates a spread over the MRO, where banks can obtain overnight liquidity. And we have the deposit rate, which is the rate where banks can place their reserves in excess of the reserve requirements. And that is fixed at a spread below the MRO rate. And as you know, MRO rate is 5 basis points, deposit facility rate is minus 20 basis points, and the marginal lending rate is 30 basis points. So that is our corridor. So under normal circumstances, and for most of the time between 1998 and say 2007, 2008, what you would call the policy rate, quote unquote, the policy rate of macroeconomic models and macroeconomic textbooks would be the MRO rate. And that is a rate that typically relates to the rate on private interbank transactions on the overnight market, which is the EONIA rate. However, since 2007-2008, the world has changed. We are in an environment of excess liquidity and also persistent frictions on financial markets, and it's no longer possible for us to define our stance by a unique main policy rate, such as the MRO. So if one were willing to proxy such a rate, the policy rate with the EONIA, one would conclude that the policy rate of the ECB today stands at around minus 10 basis points, and sometimes towards minus 15 basis points. And so our effective lower bound is slightly negative. What I would rather say is that from an operational perspective, from the ECB perspective, the lower bound corresponds to the deposit rate, also given the amount of excess liquidity that is now being reconstituted also with the asset purchase program. Excess liquidity exerts a pressure on money market rates, and so the effective policy rate for me is more the deposit rate than the marginal refinancing rate. And so it is minus 20. It can be, so it is at a negative level. It could, in principle, be kept at an even more negative level given the cost of storage and the cost of shipping physical currency. So the message here is that the lower bound has been found to be clearly below zero. We also have evidence that a large fraction of unsecured money market transactions can take place at negative rates. It is working very well. We've seen no operational hurdle to the functioning of the money market below zero. I can refer here to the money market survey, which we publish every year. Latest was published end of April, which documents very well how the money market works below zero. And so we have the proof that the money market can function in a significant way without hampering market functioning. The lower policy rates were transmitted smoothly throughout the money market. EONIA forward curves have flattened and shifted down. The volatility of EONIA rates have dropped. We haven't seen adverse effects on market conditions. On the contrary, negative EONIA rates have coincided with stable, even increasing trading volumes, which was really contrary to what nearly everybody would have predicted before we introduced the negative rates. With the experience of Japan in mind, there was an expectation that this would have an adverse impact on trading volumes on the money market, and it was quite the contrary, actually. There was very smooth transmission, very homogeneous transmission to closely substitutable market segments, such as the repo market, to start with, and the front end of all bond markets and credit markets. This suggests that the short-term nominal interest rates going below zero does not pose the difficulties for monetary policy that one would have imagined. So could we reduce the main policy rates, and in particular the deposit rate, even further? On this point, we've been very clear. The current constellation of policy rates is for us the effective lower bound, so there is no expectation that we would reduce the deposit rate further. There are many reasons for that. One reason being that we don't want to test the notion that at some point we could have less smooth reactions or nonlinear reactions, and in particular that at some point we could get closer to what is the opportunity cost of holding money. So we don't even want to test it, and we want to stay on the safe side. That would be enough of an explanation. But even more importantly, we don't want and we don't intend to lower the deposit facility rate, because we found that it is in fact not a hard constraint on monetary policy. So there is no reason for us to do it. So let me explain why it is not a constraint. Monetary conditions depend not only on short-term rates, but on the entire range of market interest rates. When the central bank, in normal times, when the central bank alters short-term rates, it is aiming at steer the whole range of medium to long-term interest rates that will in turn determine investment and consumption in the economy. So that's what we call the interest rate channel of monetary policy, I guess. And usually it works very well. So in that kind of environment, the inability to cut short-term rates further does not necessarily make monetary policy ineffective if other tools are available to influence the shape of the yield curve, the shape and level of the yield curve. So in a sense, one could argue that the true lower bound for monetary policy is not reached when the short-term rate hits the effective lower bound. It is reached only when the entire yield curve is flat at the effective lower bound. So, and that is where non-standard measures come in. What I call non-standard measures here is a subset of monetary policy that uses instruments, intermediate targets, also communication, to achieve the same final objective, which is medium-term price stability, but with other instruments than the short-term rate. So if you could follow a multi-dimensional version of the Tinbergen principle, if you want, where you would use non-standard measures as assigning a large set of instruments, which are asset purchases at different maturities, to a correspondingly large set of intermediate targets. And these are the corresponding market interest rates. The effective lower bound for monetary policy should be seen in this functional space, not along a one-dimensional line. This is about the whole structure of interest rates. And we do have a whole set of instruments that we can use to target these rates. So using this expanded set of instruments, namely asset purchases at different maturities, we can exert a direct influence on the whole structure of interest rates rather than controlling only the short-term ones. By the way, let me make let me deviate for 1 second from the main theme here. If you really see the lower bound as being a constraint in a functional space or in a multidimensional space instead of being a constraint on a single variable, which is a short-term interest rate, then you probably have to put in perspective all models and model-based simulation which assess stabilization policy at the lower bound using the short-term interest rate being non-negative as a constraint identifying the zero lower bound. In standard DSGE models, for instance, you would simulate, say, fiscal expansion or structural reforms at the zero lower bound, using as a constraint the fact that the policy rate will be non-negative at each point in time along the future path of the economy. If you take into account the possibility that monetary policy exerts an influence on longer-term rates, then this probably, I haven't done the exercise in a DSGE model, but it probably would lead to a much more benign assessment of the impact of the lower bound on stabilization policies and on structural policies. So if you remember, if you have in mind, for instance, the well-known results of, say Cristiano, Eichenbaum, and Rebello on fiscal multipliers at the lower bound, where they found that fiscal multipliers could be very high at the lower bound. If you substitute the constraint on the short-term interest rate with a constraint over the whole structure of interest rates, you probably find a much less large fiscal multiplier, because you recreate room for monetary policy to act along the future path of the economy, and that is a reality we're in. It is not the other assumption. That is a reality we've been in. So which instruments do we have to flatten the yield curve across the full spectrum of maturities? We had two instruments that we used in turn, or in two stages. The first one was forward guidance, which really nobody talks about anymore, but it is still there. I can confirm you that it's still there. And it has been very effective in our view. This has worked by anchoring expectations about the level of future short-term rates, and also by reducing the volatility around that level. And it worked very well when it was introduced in 2013 as a way mainly to protect the front end of the Eurozone money market curve from external shocks, from shocks arising from outside of the Eurozone, in particular shocks arising from US tapering. The front end of our money market curve has been extremely flat and stable in spite of all possible kinds of global financial shocks. So this has worked very well. However, forward guidance is only credible over the horizon of visibility of the Monetary Policy Committee. So there are different definitions of it. You could imagine that the relevant horizon for a Monetary Policy Committee is the term of the median voter in the Monetary Policy Committee, something like that, which would be rather long, actually, because we have long mandates. The ECB mandate is 8 years. I would rather define it as the horizon where our forecasts have reasonable credibility, or are not marred with too much uncertainty, too large standard error, which is much shorter in my view. So forward guidance is credible only up to a point, only up to a certain horizon, which is not very far away. So if we want to steer interest rates beyond that horizon, we have to do it directly by directly targeting the term premium through asset purchases. So facing short-term interest rates which had fallen towards the lower bound, the signaling power of rate movements, including future rate movements, had decreased, given that the short-term rate was now at the lower bound, and so we had to resort to the other instrument. We moved to asset purchases, as you know very well. We started the two programs of purchasing private assets, starting in September last year, and purchasing public assets, announced in January and starting in March this year. We buy public sector assets with a remaining maturity of 2 to 30 years, which is quite long. The weighted average maturity of our portfolio is 8 years, which is also rather long from a monetary policy standpoint, from a central banking perspective. It is, when you think about it, this is really an unprecedented lengthening of the horizon at which we can influence interest rates. Just keep in mind that we still do 3-month liquidity tenders, which we still call long-term refinancing operations, 3 months. So that gives you a notion of what is the long term for a central bank. And now we are doing 8 years. When we are targeting 8-year rates through our asset purchases. So these instruments have been very effective in overcoming the lower bound constraint. Forward guidance has led to a decline in the uncertainty on future monetary policy. It also has led to a decline in the sensitivity of money market forward rates to news and data surprises, which is an interesting feature of forward guidance. It has made the forward curve more stable and less sensitive to news, to economic news. We have empirical research on that. It is also clear, even if it's of course a very preliminary evidence, we started buying public assets only 9 weeks ago, but it is also clear that some of the expected transmission mechanisms of these asset purchases are already working. We've seen a decline in the forward interest rates across all maturities on sovereign and with some lag also on corporate bonds, which also shows that the portfolio rebalancing channel also works. We are seeing price equalization across market segments. The impact point of our public sector purchase program has been the long end of the sovereign curve, but then we've seen the impact spreading across assets, and not only in the credit spectrum, also to equities, which really shows that the portfolio rebalancing channel is at work. We've also seen investors reallocating investments towards non-euro assets, obviously, and this has been seen. The effect has been seen on the exchange rate, which shows that the portfolio rebalancing channel of our program is playing out in a very different way than for US quantitative easing, which started at a time where there was much more scope for spread compression in the credit universe, which we didn't have to the same extent, given that we started at a time where spreads were very much compressed already, which implied that the portfolio rebalancing channel had to play out in different ways, in particular through the international channel to non-euro assets. So it might be one of the reasons why we've seen such a price impact on the exchange rate might be that the scope for credit compression was much less than for US QE. So we still have a lot to learn about these transmission channels. We don't know much. In particular, we don't know a lot about the supply reaction. We know how demand has reacted. We don't know much about supply. We are seeing a surge in euro-denominated issuance outside of the eurozone, for instance. This is also part of the transmission channel of QE, but it's too early to say to which extent we'll see substitution of non-eurozone originated euro-denominated assets in place of eurozone government bonds, for instance. This is too early to tell. So we still have to learn about it, but it's working. Interestingly, both measures, forward guidance on the one hand and asset purchases on the other hand, have been reinforced by the fact that the effective lower bound was slightly negative. When policy rates reach zero, and even with credible forward guidance, the term structure of interest rates can steepen when market anticipates that future short-term rates can only rise. When you hit the bottom of the swimming pool, you can only go up, right? But when you remove the bottom of the swimming pool, you don't know if you're going to go up or maybe still a little bit down. If markets can be convinced that the lower bound for short-term rates is not zero, but can be made negative, then the probability distribution of future rate movements changes. And as we introduced our negative deposit rates, we've seen a significant shift in the probability distribution of, say forward EONIA rates. And we've seen as a result, we've seen also the long-term interest rate starting to flatten because we had removed because the lower bound was not zero anymore. As a matter of fact, the forward EONIA rate, say at a 1-year horizon, is today around minus 15 basis points, which is probably compatible with the probability distribution. Well, actually, you can see the probability distribution from options. And there is a significant fraction of it which is below minus 20, which is not our intention. And this we've told the market repeatedly, and I'm telling you again tonight that this is not our intention. But still, the fact that we've removed the zero floor, which was seen as really an intangible floor, recreates some space for expectations to spread, and it has helped stabilizing the forward EONIA curve, and as a result, it has helped also stabilizing the whole of the yield curve. A second remark here is that so that was for forward guidance. And the negative deposit rate also, in my view, acts as a complement to asset purchases by inducing banks to sell securities to the Eurosystem, by inducing banks that sell securities to the Eurosystem and receive bank reserves in exchange of them to lend on those balances. So it's an incentive for banks not to keep the cash overnight at the ECB. There is even a more subtle argument here that if you keep in mind that in Europe the government bond exposure has a zero capital weight under the CRD4, which is the way Europe implements Basel II. We don't have to do that, but this is the way we do it. We implement Basel II by having a zero weight on all government bonds. And so there is no capital relief for a bank that sells a government bond to the ECB. If a bank sells us a covered bond, there is capital relief. If they sell us an ABS, there is capital relief because they receive cash in exchange, and then they can use the capital that has been recreated for another purpose. If they sell us a government bond, there is no capital relief. So there is a need for an incentive here, and you can see the negative rate as being that kind of incentive. So in that way, it increases the velocity of circulation of bank reserves, and it accelerates the portfolio rebalancing channel. So as I said, we've seen a strong price impact. So I know that one of the questions you're going to ask me is whether we've been concerned by the reversal in that price action. The recent reversal in the price of the Bund in particular, but also other sovereign bonds. Is that a cause of concern? The answer is no. It is not a cause of concern insofar as it reflects a market correction, insofar as it recreates two-way risk in the market, which is healthy, and insofar as it reflects the fact that as our program is now starting to take effect, some of the more pessimistic assumptions on growth and inflation in the Eurozone are being revised. In particular, deflationary expectations are clearly receding since we started the program. And this is also reflected in the term structure. So there is no cause for concern here. What concerns us is more the rapidity of the reversal. So not the level in itself, but more the rapidity of the reversal, which after similar episodes is yet another incident of extreme volatility in global capital markets. So that feeds into the discussion of reduced liquidity on global capital markets and what can be done about it. So volatility is a concern, but the current level is not. Let me add a last remark on the asset purchase program here. That something which you have to keep in mind is that there are seasonal patterns in market activity, and we are about to face the traditional holiday period from mid-July to August, where market liquidity is much lower. So we are taking this into account in the implementation of our asset purchase program by front-loading, or let me say moderately front-loading, somehow front-loading our purchase activity in May and June to anticipate the lower liquidity, and so presumably our lower capacity to purchase government bonds in the summer. So we maintain our monthly average of 60 billion euros per month. But on average, but we know that we may buy less in the holiday period in July and August, so we'll buy more in May and June. So don't be surprised if we are buying more week after week. This has nothing to do with it's not opportunistic trading given the market correction. It is just anticipating the summer period, so that on average will be exactly around 60 billion euros per month. This is just a little bit of front loading, but I just wanted to clarify in case there would be questions. Let me come to the last part of my speech, and I've been too long already. But I come to the part which is really related to the theme of the conference, which are options to deal with the lower bound. The fact that non-standard measures, as I've just explained, can help overcome the lower bound does not mean that there might not be other ways to deal with it. And looking at the literature, and I'm pretty sure that this was discussed also today, two types of policies have been mentioned and discussed. Those that take the existence of the effective lower bound as a given and seek to improve the traction of monetary policy given the lower bound, and also those which aim at removing the lower bound altogether. Starting with the first type of policies, how to improve the efficiency of monetary policy at the lower bound and taking the lower bound as given. Several options have been proposed, but let me say that they are not very appealing to policymakers. I start with the Blanchard and Ball proposal that the inflation target should go from 2% to 4%. You can imagine that we are not great fans of that at the ECB. The reason being that first, moving to 4% would presumably impose a permanent cost on the economy, because you think of inflation fluctuating around 4%, and inflation it's a geometric process. It's not an arithmetic process. So the standard error of inflation, the span covered by inflation rates would also widen if you increase the average inflation rate, and it would be centered on 4%. So we believe that this would impose costs to the economy in terms of the inefficient allocation of resources that comes with a higher inflation rate. Also, we don't think that it would be very good for the credibility of the ECB, given that if we change our objective one, our definition of price stability once, economic agents would then entertain the possibility that it can change further, either way, by the way. So if we start making it react to short-term economic developments, it creates a lot of uncertainty in the economy. This is not what European citizens have been explained is the definition of price stability, and we've done that since 1998. And incidentally, all other major central banks have the same, well, different monetary policy frameworks, obviously, but around the same numbers. So in order to avoid creating instability in the global financial system, you would need some kind of coordinated move by all major central banks, which doesn't seem very likely to me. So raising the inflation target, for me, it is too blunt an instrument to achieve the objective of stabilizing the economy in a low-rate environment. So there are other proposals that are even more far-reaching. For instance, they involve the use of active fiscal policy to create inflation, so to support the central bank in creating inflation. Also to increase policy rates to coordinate expectations on the desired equilibrium of inflation around 2%. Neither proposal is practical in the Eurozone setup. When it comes to increasing interest rates, I think we've made it clear through our forward guidance that we don't want to do that. So there is no plan of increasing interest rates for an extended period of time. And explicit monetary policy, fiscal policy coordination is probably not possible anyway in our monetary policy, in our institutional framework with 19 treasuries and one single central bank, and it is not desirable given the independence of the central bank, which is in our treaties. And even apart from that, when you think of the aggregate fiscal stance in the Eurozone, it is certainly important to follow the aggregate fiscal stance, and certainly the aggregate fiscal stance does matter for monetary policy. We are independent, but we are still we are interdependent with governments. But my take here would be that there can be a discussion on the allocation of the fiscal stance across countries. And we've been public many times saying that countries that do have fiscal space should use it, but countries that don't have fiscal space should not invent it across Eurozone countries. So no names here. So there is a discussion, a good discussion on the allocation of the fiscal impulse, but at the aggregate level, the fiscal stance is broadly neutral, and rightly so, and we agree with the European Commission on that. So we don't see it as being desirable for the aggregate fiscal stance in the Eurozone to become much more active, given the high legacy debt, and also given the requirements of the fiscal rules which apply to individual countries. So that is a non-starter in my view. As regards the second type of policies, which are policies aimed at removing the lower bound, which I know have been discussed today. So the most prominent of them is either to tax currency holding, so that the kind of Gesell, the kind of taxing cash, or impairing cash in a way that is equivalent to tax, or maybe abolishing tax altogether, and that is the Beuter/Rogoff line of thinking. And I'm sorry that Willem is not with us tonight, because he would have been very upset by what I'm just going to say. So I'm very sure I will get an email after the dinner. So yes, one can imagine upsides associated with such policies, on top of pushing the lower bound into further negative territory. Certainly a tax on cash would be a tax on illegal activities and would foster greater transparency. No issues with that. Also, we could economize on the cost of storage and on the use of currency, which are not insignificant. And by the way, we have good studies in the Eurosystem on the cost of payments, of retail payments, including the cost of cash. We had a very nice survey across the whole of the 28 EU countries that you can find on our website, and it is significant. The cost of retail payments is significant, including the cost of cash. Still, there are important reasons why it's difficult for us to give this option a serious consideration. And they have to do with psychological, or even I would say sociological, societal factors, and also operational factors. The use of cash with a zero guaranteed nominal rate of return and a non-negative nominal interest rate on deposits is very deeply ingrained in the psyche of economic agents. Already today, as you can see daily in the press, in particular in the press of some large Eurozone economies, savers already today they perceive a negative nominal interest rate on deposits as being an unfair wealth tax, and extending it to cash from deposits to cash would deepen this perception. It would also affect the most vulnerable members of society who don't have access to bank deposits and who still keep cash. Depositors would have no other option than to keep hold of their savings, unless there would be a rapid shift of attitudes towards saving in more risky types of assets, such as equities. But then it's a whole new discussion whether it's right for savers to invest all their savings in riskier assets. And this would raise serious financial inclusion issues, such as, well, we may all in this room be familiar with the computers and smartphones. Not all people in society are. So if you want to suppress cash altogether, you need very active public policies to take care of those people who don't have access to computers and to smartphones. So by distributing prepaid cards, or I mean, there are many ways to do it, but you need strong policy action to take care of the most vulnerable in society. It doesn't come by itself. The bottom line here is that I can very well envisage a world without cash. So it's not and it will come. I'm quite convinced that it will come one day. So it's not a principled position, but I view this evolution very much as the outcome of changing technologies and the outcome of changing social perceptions, rather than the outcome of policy prescription. This is compounded in our case in the Eurozone with a huge variety of attitudes across the Eurozone, attitudes to cash. These are very different across countries. There are some countries where having more than 200 euros in your wallet would be seen as very unusual, because everything is paid by a credit card and maybe by check for those countries where it still exists. There are some other countries where a lot is still paid by cash, and where, to the contrary, debit cards are widely used, but credit cards are not widely used. So there is an anecdote I already told Signe, but so you will pardon me for that. But in my first week in Frankfurt, when I joined the ECB, I bought like 2 beds, 4 cupboards, a whole lot of furniture, etc., to settle in Frankfurt. And I went to IKEA in Frankfurt, a very big shop, a very large department store in the suburbs of Frankfurt. I had a quite significant check to pay at the end, and when I showed my Visa card, it was just not possible to pay with a Visa card. And when I showed my MasterCard, it was not possible either to pay with a MasterCard. And I didn't have an ETC card at the time. So now I know that I need to keep my ETC card with me when I'm in Germany. So I had to go back to Frankfurt, draw cash and pay cash. So, and I was the ECB board member in charge of payment systems throughout Europe. So sometimes it's good to keep contact with reality. So that just teach me a lesson that there are different attitudes to cash, and this will not be changed overnight. Besides, and that is even a more important argument, I don't believe that it would be sensible to remove the zero Eurobond in the Eurozone at the current juncture. So let me explain why. I see 3 reasons for that. The first reason is that removing the Eurobond would not solve all problems related to monetary policy. What we've learned in the global financial crisis is that the type of shocks which can drive policy rates to the Eurobond are also shocks which produce impairments to monetary policy transmission. Suppose, for instance, that the interbank market freezes, so that's 2007, and prevents a smooth transmission of the policy rate throughout the banking sector and throughout capital markets at large. In this case, any cut in the policy rate may be almost completely ineffective in terms of influencing the macroeconomy and influencing prices. So given the persistent signs of fragmentation in some parts of the euro area financial markets, it is not clear that the ability to lower key ECB rates deep into negative territory would by itself help ensure a faster return to growth in the Eurozone, because the issues are elsewhere. On the contrary, if you push deposit rates and the whole structure of rates deep into negative territory, this could have an impact on the business model of financial intermediaries, banks, insurance companies, asset managers at large, which may not, but may impair their capacity to perform financial intermediation and eventually to support monetary policy transmission. So what is okay as a temporary period where we need very low rates to push the economy back to its steady state growth path would not necessarily be okay as a steady state path, because then the structure of financial intermediation in Europe may be deeply and possibly permanently changed, and we're not sure that this would be for the best in terms of monetary policy transmission, in particular if banks lose their business model. So we don't want to try that. The second argument is that we are mindful of the risks that persistently low interest rates cause to financial stability. It is accepted today that real rates will remain below the long-term growth rate for as long as will be necessary for investment to recover. And investment recovering will in itself push the growth rate up and bring the natural rate of interest up. So that is the way monetary policy functions, and it is accepted, and we are doing it. But throughout this period where real rates will be below the growth rates, the long-term growth rates, private agents may be tempted to borrow cheap at the short end of the curve, or even at the long end of the curve for that matter, to purchase assets of which supply is limited or inflexible, such as real estate. So we are certainly prepared to use our micro-prudential tools and our macro-prudential tools to face the risk of bubbles and to face the risk of excessive leverage. But if the lower bound was effectively abolished, if the whole structure of rates were to settle into deeply negative territory, those risks to financial stability would increase, and they would lead to macroeconomic instability. And this would be what macroeconomists call a dynamically inefficient growth path, a path where the interest rate is below the growth rate, meaning that you have to invest more than the revenue on capital just to maintain the share of capital constant in GDP. And this is not how the normal growth path works. So we don't want to test that. The third reason is that, and that would be my conclusion, is that we have to reflect on why we've reached a lower bound in the Eurozone in the first place. And an important issue here is the possibility that the natural real rate of interest may have fallen very low or even gone negative. So that relates obviously to the secular stagnation discussion that we also have in Europe, or that we should have in Europe. This could happen for various reasons, such as low productivity or a slowdown in population growth, both of which are relevant for the Eurozone. Also, we've seen a protracted period of deleveraging in the Eurozone, similar to the one which occurred in Japan in the 90s. And this also could have pushed the real interest rates, the natural real interest rate down, even maybe in negative territory, and potentially for a long time. This scenario might be consistent with a gloomier view of recent bond market developments than the one I've provided above. I've told you a story where we keep interest rates low because we want to support investment. Investment will recreate potential output and will recreate profitable investment opportunities. The real interest rate being low will recreate profitable investment opportunities, which will push the natural rate of interest up, and we'll be back to square one. But if you look at what the forward curves tell us, it might be a different story. If you look at the expected short-term real interest rate, say the forward spot real interest rates as extracted from the forward curve today, at 10-year ahead, it is minus 1%. So the spot forward real interest rate is minus 1% in real terms, not in nominal terms, in real terms. If you compare it to Eurozone GDP, Eurozone GDP for 10-year ahead, if you look at the consensus forecast, it is plus 1.4%. That's what the consensus forecast tells us. So, well, there are two ways to look at it. Either the forward market is wrong, and the forward curve is distorted by our own action, by us buying bonds, compressing the term premium, which also compresses the forward structure of rates. And what we see in the forward market is mostly the impact of monetary policy action, and it's not really an expectation of future rates, as it should be in forward markets. It is distorted by monetary policy, and then it may be fine, because then real rates may come back up and settle at a level which can be close or even above a long-term growth rate. If forward rates are right, then obviously we are in deep trouble. This means that the natural rate of interest will not come back in the Eurozone, and that signals very bleak prospects for Eurozone growth. So I find comfort in the empirical literature that says that forward markets are always wrong, and that's the good news probably. But still there is a risk that we would be in this very bleak environment where real rates will remain very low for an extended period of time. And I guess it is in response to this scenario that some are proposing to remove the effective lower bound, to allow us to operate monetary policy along this path. But then my question is, why not instead focus on raising the natural interest rate rather than finding ways to live with a very low and negative natural rate of interest? Why not focus on raising the natural rate of interest? Why not do structural reforms that will raise investment demand, that will raise total factor productivity, that may raise demography? That's more challenging, but that's part of the macroeconomic discussion, if not of the political discussion. This would be positive for employment and productivity growth. It could have positive effects even over a relatively short time horizon by creating expectations of a higher potential growth. This can help companies to invest already today and consumers to consume already today. This would be a much better way to invest political capital than by taxing deposits or withdrawing cash, which would be a hugely controversial political operations. So my conclusion is better invest your political capital in reforming the economies and bringing the real rate of interest up so that that discussion returns back to the theoretical domain. Thank you.